Hi everybody. My name is Ken Crotty, and I want to welcome you to we're going to go through a calculator on estate view. It's going to be for self-canceling installment notes. So one thing I'd like to do when we talk about the self-canceling installment notes is first we're going to start with the standard description of the self-canceling installment notes. This is our normal intake, and again, this is under the standard mode. And what I've done is I've moved it over to the left-hand side because I find it helpful to be able to go through and explain what a self-canceling installment note is generally. And then what we can do is we can go into the detail of the various items and what we can do to show both for a client how the self-canceling installment note can save estate taxes, but also what other options there are available when you structure the note and how you can structure that in the best way for the client. So with a self-canceling installment note, what a client does is the client sells assets to an irrevocable trust. In most situations, the trust itself is a defective grantor trust, meaning that the client's treated as owning it for income tax purposes. And as a result, there's no gain recognized on the sale. The sale is ignored for income tax purposes, and we're not generating any income that the client needs to pick up on their personal 1040. Now, with a regular promissory note can be structured for a term of years. It can be structured as an interest-only promissory note, or maybe it's an amortizing promissory note. We have options on what the payments would be. Typically, the rate for a typical promissory note is dependent on what the applicable federal rate is. And it depends on the length of the note. And so you would determine whether you have a short term or a midterm or a long term note, depending on the length. And then you would pick the applicable federal rate that applies to that. With a self-canceling installment note, one thing is different is from a regular promissory note is that if the seller dies during the period that the promissory note's outstanding, then the obligation of the purchaser to make any additional payments, whether it's interest or principal, ceases to exist. It cancels on the death of the seller. And so to take into account the fact that the seller might not get repaid, the IRS requires that when we calculate the interest rate or the principal that is going to be part of the sale, that we calculate that with a premium. And the premium takes into account, again, the fact that we might not get repaid. So again, if I have a regular promissory note, and let's say it's a 20-year promissory note, if I die during the 18th year, that obligation is still owed to my trust or me individually, my estate. But either way, that regular promissory note is still owed to my estate. It's still an asset that's included in my estate, and the value of what's owed is included in my estate and could be subject to estate tax. And so what's nice with a self-canceling installment note, again, is that I can sell the assets and I'll have this promissory note that's owed back to me during my lifetime. It's going to provide me with an income stream of payments during my lifetime. But on my death, there's no further obligation of the trust to repay any of the outstanding balance. And as a result, we're able to transfer assets without being subject to estate tax. And it's a really nice mechanism that we can use. So again, take into account the fact that the principal that's being loaned might not be repaid, or the interest that's outstanding might not be repaid. The IRS allows us to charge either a principal risk premium or an interest rate risk premium. And so that's what we see here on the standard mode. So the principal risk premium means that what we would do if we're selling $1 million worth of assets is that we could use the more common or the more normal interest rate. But what we have to do is we have to mark up that $1 million worth of assets and say, let's say that the principal amount owed would be $1.2 million. So it's $1,200,000. And again, that's that principal risk premium. The other option would be an interest rate risk premium. And so if a typical note would charge 4.5%, with the interest rate premium, maybe that what takes into account the fact that the seller might die during the term, and the IRS might calculate that as an additional 4%. And maybe now the interest rate for the note is 8.5% instead of 4%, or 4.5%. So that's that interest rate premium. And the interest rate with the premium is the total interest rate that's being charged. And then other term amounts, just to make sure we're on the same page, we have the note amount. That's what would be the amount that's outstanding, and it's either the original principal or it's the marked up principal with the risk premium. And then you have your annual payment, which again is the interest rate with the risk premium if applicable, times the principal outstanding with the principal premium if applicable. And that'll get you your payment. Couple of warnings, and this is just to go over SCINs in general. And again, a self-canceling installment note, we call it a SCIN, SCIN. If you see that, that's what this is referring to. So if you have a life expectancy that's less than normal, there's a possibility of a gift being imputed on the sale. So the idea here is that you should be charging a certain amount of a premium, whether it's an interest premium or a principal premium related to a SCIN. The SCINs are determined based on the life expectancy of a willing buyer, willing seller, full knowledge of all the facts, is what the IRS would argue. The SCIN tables themselves are based on actuarial numbers, based on the averages for an individual at a certain age, and it does not take into account factors such as lifestyle or diagnosis or other things. So if you are in a situation where you're planning for a client who's got a reduced life expectancy, you might be in a situation where you're making a gift. It's something you need to look into. With respect to the assumptions that we use for calculating the SCIN, it's important to note that there is actually no bright line clear test from the IRS regarding this. The rule of thumb that the industry uses is that we apply the same assumptions that we do to a private annuity for calculations. And that is how we come up with the number for the SCIN, the premiums. But again, it's not 100% foolproof, and it could be subject to challenge. All right. If the client lives past the term of the SCIN and the note is repaid, then you're going to be in a situation where you've actually caused more assets to be pulled back into the estate of the grantor, because again, you're in a situation where you've had higher interest payments or you've had higher principal payment coming back. And either way, what you've ended up doing is probably increasing the gross estate of the grantor, or you certainly haven't decreased it the way that even a traditional promissory note would have. Right? So again, if there is less than a 50% chance of an individual dying from within 1 year of when the transaction is entered into, then there's less of a chance of the transaction being recharacterized and the client having made a taxable gift. That's again a situation that needs to be looked at on a case-by-case basis. All right, so those are all of my warnings. So now let's get into what we can do with the actual information and what our inputs are. So again, this is our self-canceling installment note calculator, and this is just the standard inputs. And again, you can see up at the top here, we've got standard, we've got pro, and we've got Pro Plus. And what happens, and you can see by the size of the bar on the right-hand side here. So here's our standard bar, meaning that we don't have a ton of options. That gets smaller when we click to the Pro version. Right? And then it gets smaller again when we click to the Pro Plus. So again, more options under Pro Plus. Middle of the road is Pro. Standard is where we'll start. So our first option, and this goes to the projections to show you how effective the estate planning technique is going to be, is what are we going to do with the lifetime exemption? As we know, there could be no reduction in the exemption. There's a possibility of the exemption being reduced in half, which is the 2026 default. And then we've also projected the possibility of it being actually reduced to $3.5 million. I think using the base reduction in half in 2026 might be a good way to start, and that's what we're going to do today. And so this assumes that Congress is not going to take any action before the end of the year, that the tax cuts that are in effect are going to expire, and that at the end of 2026, we'll each have exemptions of roughly a little bit more than $7 million instead of the more than $14 million that we would otherwise. All right. With respect to the 75/20 rate, that is a rate that is published by the IRS. You use the applicable 75/20 rate for the month that you're in. And for this month, if we're going to do the transaction in June, the 75/20 rate is 5%. Now, the AFR that we have, that AFR rate is going to depend on, and again here, it's 4.56. And so it's going to depend on the length of the note. So with a 4.56 note, that means that I've got a long-term note, which means it's a note that's longer than 9 years. So if I have a 9-year note here with a midterm rate, you can see it goes down to 4.03% is what the AFR would be. And again, the AFR, you can either use the month that the transaction, when you're entering into a sale like this, you can use the month of the transaction, which would be June, or you can use a lower rate, which may be May or April. So you can use the month of the transaction or the 2 months prior. You pick the lowest rate, and depending on the term, you're going to have, that's what picks out your AFR. So again, here I changed the term of the note down to 9 years. That means I'm a midterm AFR of 4.03. And again, that's the lowest of June, May, and April. If I go more than 9 years, so let's put it back to the 15-year note that it had been. Now I'm in a long-term AFR. With the long-term AFR, the rate for April actually is higher at 4.71. May 4.57. April is the lowest at 4.56. So again, using April as the lowest number, 4.56, that's what calculation we will use to determine the interest premium and the principal premium that are applicable. Now with a self-canceling installment note, we can actually have it on 1 life, or you can have it on 2 lives. That's a toggle that we have as an option right here. For right now, for the standard demonstration, we'll just keep it at 1 life. In the grantor's age, we need to put what their age is. Now, just as a reminder, with the IRS, you actually turn your birthday 6 months before and 6 months after the actual date. So if I was born on December 23rd of 1958, then my birthday, you would think, would be on December 23rd, meaning that I would be 66 years old right now, and I would be 67 years old for the purposes of the calculation. I wouldn't turn that until December 23rd. So you would think that from June 23rd through December 23rd, I would continue to be treated as 66 years old. But that's simply not true. If what we do is we go ahead and we were going to move the date of the sale forward, and we can move it forward a day. But basically what I was doing is if I make this the 22nd of December, you'll see now I'm 67 years old. So if I enter into a transaction, a SCIN, and it's 6 months before or 6 months after my birthday, I'm actually the age that I turned on that birthday or will turn on that birthday. Okay. So again, right now, if my birthday is on December 23rd, this is the last day of the year that I would have, the last day, to be treated as a 66-year-old for the purposes of this transaction. Right? If I do it tomorrow, or if my birthday was December 22nd instead of December 23rd, then I would be treated as being 67 already for the transaction. All right, so I hope that makes sense. But again, what we can do here is that we can put in the date of birth. And so I'm going to put in 12/22/1958. And because we're within 6 months of that date, it means I'm actually treated as being a 67-year-old. So now that I know how old I am, I would come back to this grantor age nearest birthday, and let's put that at 67 years old. Now with a 67-year-old, the average life expectancy is 17.16 years. Now, one nice thing about Estate View is that with a lot of conventional software programs, you can only do a self-canceling installment note for a term that is equal to or less than the average life expectancy. Estate View actually allows you to increase that calculation and have the term of the note be longer than what the life expectancy would be. And as a result of the longer term, that increased risk premium will be calculated accordingly. And you'll either have a higher interest rate or a higher principal rate, depending on what's important and which one you're applying. All right. So again, here we're going to go with a 17-year note. So let's say we want to keep it just below the average life expectancy. So 17 years is just below the 17.16. And with this type of a situation, again, we can either charge a principal premium or an interest premium. I like charging the interest premium as opposed to the principal premium for a start, at least for the purposes of the analysis. And then the last thing you can pick is your payment type. All right. So you can either have an amortized payment, so it would be an equal payment over the course of the loan, or interest only. Typically, if we're doing this for estate planning reasons and we're worried about trying to reduce, or not worry, but the planning idea is to reduce the client's estate tax exemption or estate tax exposure, then what we can do is most times we would charge the interest only payment. So the interest only payment as opposed to amortizing means that I'm going to have less payments coming back into the grantor's gross estate. As a result, the estate's going to be less, it's going to be smaller, and we're going to have less estate tax due. If I amortize the payment and the client dies halfway through the note, then half of the principal essentially would come back in. And that's not as good of a benefit to the client as it would be with an interest-only payment. And for the sale, what we'll do is we'll say that this is going to be $1 million. All right. So if we click to see the results, and by doing this on the results, what we have here. So again, this is our summary screen. So we have the grantor's age 67. Second life, we didn't pick it. Term of the note, 17 years, $1 million. Interest-only payment type, interest rate for the premium. 75/20 in the AFR are picked based on what we've input before. We're not using the principal risk premium. Again, it's $1 million note. So the interest rate risk premium is calculated at 3.4672%. So that means that the risk, according to the IRS, of a 67-year-old dying during a 17-year note is equal to 3.47 or 672% of interest, additional interest. So in this situation, our base AFR was 4.56, and we add the 3.4672 to that, and we get 8.0272%. So the annual payment is going to be 8.0272% of the outstanding principal, which is $1 million, meaning that my annual payment is going to be $80,272. Right? And again, you can see that on the timeline in the chart here that we have. All right, so this shows the growth of the assets that are held by the trust, as well as the beginning value, and then the payment as well. All right, so what I'd like to do, this is the timeline, and we have the probability of survival by age, which also shows you the likelihood of actually surviving to the particular point. And then we have the trust value over time, which shows the growth of the property. All right. Now, if we go back to the summary and the details, what I'd like to show is that if we go back and let's go all the way to Pro Plus, because we're already about 20 minutes into this, 15 minutes into this, and it would be better to be on Pro Plus. So maybe what I'd like to do then is let's go through the Pro Plus options and create another promissory note. So we've got our base promissory note here. What I'd like to do is I'd like to duplicate that. So now we're going to be in sale 2, which is what we have here, right? The highlighted sale. And so what this allows us to do is to run a comparison showing what the note we're working on now would look like compared to the note that we had picked before. All right, so to keep things similar, we can say we're going to keep this as the same age or same individual, a 67-year-old. And again, it's going to be on one life. But maybe this time we want to see what it would look like if we did it for 10 years, because maybe we feel that they've got a short life expectancy. And we want to see what actually that impact would have. And so then here, we've also got the self-canceling note again, instead of the conventional note, because that's what we're talking about. And then what we're going to be doing, again, the premium payment is an interest-only payment. A payment type, rather, is interest-only. The premium, rather, is an interest calculation. Now we have assumptions for the estate. These are assumptions that you can put in to help calculate the size of the estate for the client to see what the estate tax savings would be. You have your entire estate amount assets, the annual spending, lifetime exemption, consumer price index, estate tax rate, annual growth rate, and then annual investment tax rate. And so these are all, assumptions that you can fill in. They go to the size of the grantor's gross estate, and you can see how effective the planning is to avoid estate tax. Then the year one gift. Typically, when we're making a gift or a trust, if the trust is involved in the sale, we want the gift to be equal to 10% at a minimum of the value of the sale. So in this situation, because I'm selling $1 million, the year one gift would be equal to 10% of that, All right. For the sale value, we also have the ability to run projections where we can run a discount rate. This would mean that instead of selling $1 million worth of Apple stock, maybe I contribute the Apple stock to an LLC. The LLC has voting and non-voting interests. After a little bit of time has passed, I could sell the non-voting interests in the LLC to this trust in exchange for the self-canceling installment note and maybe apply a 30% discount. So that would mean that instead of having $1 million self-canceling installment note back to me, I'd only have a $700,000 self-canceling installment note. And obviously that would be more effective for transferring the wealth, but it doesn't go to the value of the skin other than determining the principal amount outstanding. It just goes to more of the leverage and the effect that it has for transferring wealth. All right, and then we have some additional items that you can plug in at the bottom as well to show you the impact of what this will have on the actual growth. So, but what's more important to me, and for the purposes of this example, is that, again, what's the difference between the two notes? The two notes, what we changed is the term of the note, like you see here. And so we changed this down to a 10-year note, right? So again, we're dealing with someone with a 17.6-year life expectancy because they're 67 years old. Here we're doing a 10-year note. Because it's a 10-year note, the likelihood of the client dying during the interim period before the repayment is less than it would be as a 17-year note. So therefore, there's going to be less of a premium charged. And so when you look at this, the interest rate risk premium, again, for a 17-year note, the first line, the white line, or gray line, it's 3.4672%. That gets reduced to 2.7296%. So the total interest payment each year on a 10-year SCIN is equal to 7.2896%. So you're only paying an additional $8,000, roughly $7,000, $7,500 in that range, $7,500 per year. You'd be paying that each year to be able to have a 17-year window in which the client could die without causing the inclusion of the principal, as opposed to a 10-year window. Again, so this shows you the difference. So let's say we want to duplicate that again. And now we're into sale 3, and maybe we want to go the other way. Maybe we say, you know what, the client they're going to live for a long while. And so maybe we go out to 25 years. And so again, we've changed this now to 25 years. And I'm making lots of pretty colors. There we go. So we've changed this to 25 years. And with respect to that, then the interest rate, because of the possibility of not being repaid, that goes up from 3.46 to 4.31. So my total interest rate is 8.8765 instead of 8.0272. All right. Again, so that's how it would impact as far as if we were just changing the values. So let's delete these two. And now let's duplicate sale 1 again. And this is one thing I really do like about the software, is the ability to duplicate and delete, and you can see the various items that we have here. I like looking at just the numbers right now to show the interest rate and the premium and how that's impacted for the SCIN, because to me, that's the purpose of this calculator. The actual projections, again, with the timelines and charts, that's something that you can go through and see the big benefit here. Like, for instance, this is showing the timeline and the value of the trust. And so you can see the trust, with the increased value of the $1 million seed gift plus the $1 million sold to it, it's 1.1. We have it growing and growing and growing. And then in this situation, it needs to make the principal payment back. So that's why you can see that it's gone down to this level. And then we come back up to the growth as well. So using just a basic self-canceling installment note with our basic assumptions that we have here, the 7.5% growth rate over time, no discounts or anything else applicable. Even just using this basic planning technique, even if the grantor survived, you would still be transferring close to $200,000 worth of wealth out of the estate. Now, if the grantor died prior to the death, or prior to rather the term, in that 15-year window, you'd be looking then at transferring closer to $1.1 million. All right, so again, these timelines and the other things are items, the projections are similar to the other calculators. So going back to this calculator for the SCIN, again, if we look at this and we're trying to duplicate, what I'd like to show too is let's go down to here, and we're going to say that instead of a premium type being interest only, let's say we wanted to make it a principal premium. So again, so what we've got here is the same payment summary. It's the same note, same terms, 18 years till date of death, term of the note 17 years. And instead of $1 million, what happens is that you need to increase the principal to $1,490,148. And you keep the interest rate at the 4.56%, which is the AFR. You don't add a applicable, or there's no interest rate premium that gets added. So 4.56, and what ends up having or resulting is that the annual payment actually is less in the 67,951. But if you do remain, if you do survive to the end of the 17 years, then your payment at the end of the year, the principal payment, instead of the $1 million back, it's the 1,490,148. All right, so that's just an interesting item to look at. And then if we went back to an interest-only note, we can see we're identical, right? But then if I made the payment amortizing instead of interest only, you can see that again, what happens is that because there's more of a likelihood of getting some or all the payment back, the interest rate with the premium gets reduced. So my total interest rate premium is only 2.8579 instead of 3.4672. That means the total interest rate is 7.4179 instead of 8.0272. But here, when you have your annual payments, because the annual payments also are part principal, you'll see then that that's why the annual payment is higher per year of 105,409. And again, what we have, like in most of the other calculators, is you do have the year by year example down here. So here's sale 1, here's sale 2. Sale 1, again, what we're showing, and this is the various calculators showing the growth of all the assets and the growth of the trust and the other items. But if we focus on the trust, we start with $1,000,001. We're having the trust grow at the 7.5 per year. And then also the trust making the necessary note payments of the 80.72 per year. And then you can see down in year 17 is when the final payment's made, which reduces the exemption or reduces the effectiveness of the wealth transfer. And if we are looking at number 2, again, looking at the value of the trust, and what we can see is now we have the note payments and you have the trust value at the end of the term. And again, because the beginning note balance of the trust is being reduced. And so in this situation, the payments, the 17th year, you've received all but 98,130 of the actual full payment back, of the principal payment back. And you can see actually that in this situation, that what happens is that the trust value, it's there, and it actually, it's comparable, in that if we look at the value of the trust right after, the trust ending value would be 388,067, and then if we looked over here again, it's 184,761. So you actually would have a better savings if you survive the term, using the amortizing note, which is interesting. But if you're betting that the client's going to die during the term, then the actual regular interest-only note is a better result. So what I'd like to do is go back to delete this real quick and then show you also one other option that we haven't touched on before, and this is nice, is that you can do the number of lives. So I can have a self-canceling installment note, which is calculated based on my life and on the life of my spouse. So let's say that my wife is 65, and let's say that I am 67. Our combined life expectancy then is 23.3 years. So again, we could push this note up to, let's say we wanted to go right underneath our life expectancy. So the term of the note would be 23 years. And then we can, obviously illustrate different years of death and other items there. We're going to keep it as self-canceling, interest only. And the difference here is that because we're using 2 lives, the interest rate is a little bit less with the premium. So here, interest rate premium 2.0471, total interest rate 6.6071. So basically right here, what you're looking at is that we could have a 23-year note. So my wife and I could sell $3 million worth of assets to a grantor trust. And for the next 23 years, we could get roughly $2 million, or roughly a million, I'm sorry, roughly $200,000 worth of payments. I'll get it yet. 6.6071% of 2 million. So you're looking at roughly 200,000 or so of or of 3 million rather, roughly 200,000 of payments each year for the next 27 years, or 23 years rather. And if we die during that term, then that extra 3 million that we sold passes estate tax free. So it can be very effective as a planning technique. And what I'd like to do is just to duplicate this. And actually, hold on one second. If we go in here, I'd like to go to with the 2 lives, and let's just put this down to the 15-year note. And then if we duplicate this, and let's do it on 1 life, and bear with me here, because I just want to show you kind of the comparison. And so, and then if I duplicate that, and we do that on 1 life. Okay, so here I've got 3 different notes. So I have one note where if I have a 67 and 65-year-old, you can see the life expectancy is 23.3%. If it's only 67-year-old signing the note, the life expectancy is 17.6. And if it's only 65-year-old signing the note, the life expectancy is 19.1. So for this, what I did is I picked, let's just say, a 15-year note. All right. So with a 15-year note, if it's an interest-only note charging an interest premium with a joint life expectancy, the difference in the note is the interest rate rather is 1.1448%. So again, what that means is that the total payment, when you add it to the 4.56, means that you'll have a payment of 5.7048%. If we only have it on the life of the 67-year-old, and again, it's a 15-year note, all the same assumptions, our interest rate is 2.1% higher. So it's 7.8055%. And if we only have it on the life of the 65-year-old, and again, 15-year note, same assumptions, the interest rate's a little bit less, 7.3482%. So what's nice is that you can use the software, and I find it really convenient to be able to duplicate like I'm showing you here, to be able to show different projections for the client. And then as you know, depending on which way your client learns best, you might want to show them the timelines and the charts, showing the trust values, or you might want to show them the summary detail. And with respect to the summary detail, you might want to just show them this portion. Or the other option would be that with respect to each trust, we can show them a lot of detail. And you can pick which of these columns you want to see. You can hide some of them. You can export it all to Excel. The calculator works the same way as the other calculators do. But if your client really wants to get into the detail, you can pick and see the various items. And again, with the calculator, the way that this works is the green year is the year that the trust makes the actual principal payment or the last payment, and the red year is the date of death. Or ineffective, the various transactions could be, depending on how you want to structure it. And again, we walk through, you can start with the standard. It's going to have a lot less options, but it's a good place to start. And then you can work your way up to Pro and Pro Plus. Use the duplicate feature and get a better understanding, and you'll have a good idea of how impacts, depending on the term of the note, whether the length of the note and whether it's principal or interest only, whether you're amortizing, what premium you pick, and you can see how that does have a significant impact on the payments that are coming back to your clients, so that you can modify the payment to a structure that's going to work well for the clients and their estate planning. So hope you found this as something that will be effective and helpful for you, and I appreciate your time. Thanks very much.